This is part 2 of the presentation for Module 8 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will study stock-based compensation, including restricted stock and options. Common stock has been an important component of executive compensation for decades. The general idea is that if the company executives own stock, they will have an incentive to increase its value. This aligns the executive's interests with those of other stockholders. The amount of the stock award is often tied to corporate performance targets, including sales, income, and stock price. Stock-based compensation plans motivate employees to work hard and make decisions that improve company performance. These awards also encourage employee retention and longevity. Most plans require that employees earn the right to own or purchase shares over time. The period of time over which ownership rights are earned is called the vesting period and usually is a few years. During the vesting period, employees have a greater incentive to stay with the company. There are a variety of stock-based compensation plans that are widely used, and many companies maintain more than one of these plans. Restricted stock plans have been gaining in popularity. Employees receive shares of stock but are restricted from selling the shares during the vesting period. Similar to restricted stock are restricted stock units that confer the right to receive a specified number of shares or cash equivalents after a vesting period. Employee stock options give the employee the right to purchase shares at a fixed price for a specified period of time. Stock appreciation rights pay employees in cash or stock for the increase in share price, but employees do not purchase shares of stock. Last, employee share purchase plans allow employees to purchase shares directly from the company at a discounted price, usually 85% of the prevailing market price. Most stock-based compensation plans contain forfeiture provisions if the employee is terminated for cause or leaves before vesting. There are two analysis issues relating to stock-based compensation plans: expense recognition and potential dilution. The expense side is straightforward. When shares or options are awarded to employees, companies estimate the fair value of the award and recognize the fair value as compensation expense in the income statement over the period in which the employee provides services. Dilution relates to the number of common shares outstanding that have a claim against the company's earnings or net assets. Stock-based compensation plans have the potential to increase the number of shares outstanding and therefore dilute earnings per share. Dilution affects the value of each share of stock. If a company is worth $10 million, the per share price of the company's stock will be half as much if there are 2 million shares outstanding than if there are only 1 million. Johnson & Johnson reports that the company settles employee benefit equity issuances with Treasury shares. Treasury shares are replenished throughout the year for the number of shares used to settle employee benefit equity issuances. Companies like Johnson & Johnson will repurchase shares in an effort to counter the dilutive effects of share issuances under stock-based compensation plans. Regardless of the type of stock-based compensation plan, there are common steps that companies follow in accounting for them. First, the award is granted to employees at which time the company estimates the fair value of the award. The fair value is recorded as an expense in the income statement ratably over the vesting period, and additional paid-in capital is increased by the same amount. When the shares are issued, common stock and additional paid-in capital increase in the same manner as for stock-based stock issuances. Stock-based compensation expense is included on the income statement but rarely reported as a separate line item. Like other forms of compensation, the expense is included in cost of goods sold for employees in the R&D and manufacturing areas, or in selling and administrative expense for employees in those areas and executives. However, we can determine the amount of the expense from the statement of cash flows. Because stock-based compensation is a non-cash expense, companies add back this expense in the statement of cash flow. In 2018, Johnson & Johnson added back $978 million of stock-based compensation expense to arrive at cash from operations. The stock-based compensation add-back might lead some to conclude that this form of compensation is cash-free, but this is not correct. A real cash cost occurs when the company buys new treasury shares in the open market to offset the dilution created by the share award to the employees. Consider also that the company used stock-based compensation instead of paying higher salaries or bonuses in cash. The employees have bartered for stock. So while companies and analysts often add stock-based compensation expense back when computing and reporting non-GAAP measures such as EBIT and EBITDA, that treatment is not correct. Stock-based compensation expense has a real cash cost. To accurately evaluate and forecast operating cash flows, analysts must either include stock-based compensation expense or recognize the related treasury stock purchase as an operating cash flow. The potential dilution of earnings per share previously mentioned is a required disclosure in the income statement with details provided in a related footnote disclosure. Two facets of the company's stock-based compensation plan activity and fair value are disclosed in the footnotes. The plan activity includes the number of shares granted and vested during the year, as well as the number of shares that were forfeited because employees left the company or failed to exercise options within the specified time period. Johnson & Johnson reported the information related to plan activity for its three types of compensation plans as shown on the slide. The fair value of the stock-based compensation awards and how fair value was determined for the various plans is disclosed in footnotes also. Restricted stock awards are valued using the share price on the date of the award. Stock option plans are valued using option pricing models such as Black-Scholes or the bilateral model. The expense reported on the income statement is disclosed, and the intrinsic value, which is the difference between the value of the shares issued over the price the employees paid. Johnson & Johnson disclosed the per-share fair values for stock-based awards issued during 2018. For Johnson & Johnson, the fair value of restricted stock units is much higher than the fair value of the options because the two compensation arrangements differ greatly. If stock price drops between the grant date and the time the shares are issued, the employee with the restricted stock units will still receive something of value, the shares. The employee with an option could buy the stock at the predetermined higher price, but it makes no sense to pay more for the stock than its market value, making the option worthless, and the employee is left empty-handed, which is one reason why restricted stock plans have become more popular. In this learning objective, we will analyze dividends and stock splits. Dividends can be paid in cash, in land, in other property, or in additional shares of stock, which are called stock dividends. Stock splits occur when the company distributes additional shares of stock to existing shareholders. Companies typically pay dividends on a quarterly basis. Investors and financial analysts closely monitor dividend payments. It is generally perceived that the level of dividend payments is related to the company's expected long-term recurring income. Accordingly, dividend increases are usually viewed as positive signals about future performance and are accompanied by stock price increases. By that logic, companies rarely reduce their dividends unless absolutely necessary because dividend reductions are often met with substantial stock price declines. Two common metrics that analysts use to assess a company's dividends are dividend payout and dividend yield. These ratios are computed for common stock dividends and not for preferred stock because most preferred stock has a stated dividend rate such that a payout ratio is not meaningful. The dividend payout ratio measures the proportion of the company's earnings that is paid out as a dividend. The dividend yield is tied to the current market value of the company's stock and measures the cash return to shareholders given the cash investment. The dividend payment for Johnson & Johnson for 2018 was 62%. By comparison, the median dividend payout ratio for S&P 500 companies in 2018 was 30%, with 17% of those companies not paying any dividend at all. More mature companies like Johnson & Johnson tend to have a higher payout ratio because they have fewer investment opportunities that require cash. Johnson & Johnson's dividend per share in 2018 was $3.54, and its closing stock price on December 31, 2018 was $129.05, producing a dividend yield of 2.7%. Cash dividends reduce both cash and retained earnings by the amount of the cash dividend paid. To illustrate, assume that Johnson & Johnson declares and pays cash dividends in the amount of $10 million. The financial statement effects include a decrease in cash and retained earnings of $10 million. Dividend payments do not affect net income but reduce retained earnings. Dividends on preferred stock have priority over those on common stock, including unpaid prior year's preferred dividends, called dividends in arrears when preferred stock is cumulative. To illustrate, assume that a company has 15,000 shares of $50 par value, 8% preferred stock outstanding. Also assume that the preferred stock is cumulative, which means that unpaid dividends accumulate and must be paid before common dividends. The company also has 40,000 shares of $5 par value common stock outstanding. During its first 3 years in business, the company declares dividends of $20,000 the first year, $260,000 the second year, and $60,000 dividends the third year. Cash dividends paid to each class of stock is shown on this slide. In the first year, all dividends declared go to the preferred stock, and there are $40,000 of dividends in arrears because the full preferred dividend is $60,000, calculated at 8% of the par value of $750,000. In the second year, the preferred stock would receive the $40,000 dividends in arrears and the current year dividend of $60,000 for a total of $100,000. The common stock would receive the remainder of $160,000. The last year, the preferred stock would receive the entire $60,000, but there would be no dividends in arrears since the entire preferred dividend was paid. A stock split happens when a company issues additional common shares to its existing stockholders. Stock splits are usually prompted by the company's desire to reduce its stock price in order to improve marketability of the shares. There seems to be a psychological hurdle for investors when the price of a share exceeds $100. A typical stock split is 2-for-1, which means that the company distributes one additional share for each share owned by shareholders. Because there is no cash flow effect from a stock split, the company's market cap is unaffected by the split. Following the distribution, each investor owns twice as many shares that are each worth approximately half as much. Although the split itself has very little effect on shareholders, the price per share is reduced, thus increasing the marketability of the shares. A stock split is not a monetary transaction, and as such there are no financial statement effects. However, companies must disclose the number of shares outstanding for all periods presented in the financial statements. Additionally, companies must reduce the par value of the stock proportionately for stock splits, and historical financial statements presented in the current 10-K must be adjusted likewise. One common way to perform a stock split is to declare a dividend payable in company stock. The company adds the par value of the stock distributed to the common stock account and subtracts the same amount from retained earnings, similar to a cash dividend. Thus, there is no effect on total stockholders' equity. For example, TJX Companies announced a 2-for-1 stock split in the form of stock dividend paid on November 6, 2018 to the shareholders of record at the close of business on October 30, 2018. After the split, outstanding common shares doubled to approximately 1.3 million. In this learning objective, we will interpret accumulated other comprehensive income and its components. Unrealized gains and losses arise when the fair value of an asset or liability on the balance sheet differs from its cost. For most assets and liabilities, unrealized gains and losses are not reflected in net income nor in retained earnings because the company has had no transaction to create a realized gain or loss. There are selected items recorded on the balance sheet at fair value with any unrealized gains or losses added to accumulated other comprehensive income, a stockholder's equity account. Unrealized gains and losses are held in accumulated other comprehensive income until the realized asset is sold or liability is settled and any gain or loss is realized. Foreign subsidiaries often maintain their financial statements in foreign currencies, and these statements are translated into U.S. dollars before the subsidiary's financial statements are included in the company's 10-K. The strengthening and weakening of the U.S. dollar vis-a-vis foreign currencies results in decreases and increases in the U.S. dollar value of subsidiaries' assets and liabilities. Because subsidiaries normally have positive equity, a weaker U.S. dollar creates an unrealized foreign currency gain. Conversely, a strong U.S. dollar creates an unrealized loss. These unrealized gains or losses in the U.S. dollar value of subsidiaries' assets and liabilities are included in accumulated other comprehensive income. Also, unrealized gains and losses on some pension investments and pension liabilities are recorded in accumulated other comprehensive income. Investments of marketable debt securities are reported at fair value on the asset side of a company's balance sheet. If the fair value differs from the security's cost, there are unrealized gains and losses on these securities included in accumulated other comprehensive income. Beginning in 2018, gains and losses on available for sale equity securities are no longer deferred in accumulated other comprehensive income until the securities are sold. New standards require firms measure these equity securities at fair value with changes in fair value flowing to the income statement. Unrealized gains and losses on certain financial securities, derivatives that companies purchase to hedge exposures to interest rates, foreign exchange rates, and commodity price risk are included in other comprehensive income. As is typical of many companies, Johnson & Johnson's accumulated other comprehensive income account has become more negative over the past few years for two main reasons. Johnson & Johnson's foreign subsidiaries maintain financial statements in their domestic currencies. The foreign currency translation of Johnson & Johnson's foreign subsidiaries has resulted in additional unrealized losses of $1,518 million due to the strengthening of the U.S. dollar, resulting in accumulated other comprehensive income becoming more negative. Certain gains and losses in pension plans and other post-retirement benefit plans are not included in net income but are instead deferred and held in other comprehensive income until recognized on the income statement in future years. Johnson & Johnson has large accumulated losses in other comprehensive income related to employee benefit plans. During the year, market values on the accumulated other comprehensive income items inevitably change, and so do the unrealized gains and losses in accumulated other comprehensive income. It is important to remember that changes in unrealized gains and losses do not flow to the income statement as they are not part of net income. Instead, those changes are aggregated and labeled other comprehensive income. The graphic on this slide depicts the relationship between net income and retained earnings and between comprehensive income and accumulated other comprehensive income. This slide shows Johnson & Johnson's 2018 Statement of Comprehensive Income. During 2018, Johnson & Johnson reported an other comprehensive loss of $1,791 million. This represents the amount by which accumulated other comprehensive income changed during the year, primarily due to the large foreign currency translation loss of $1,518 million owing to a stronger U.S. dollar, as was mentioned earlier. In this learning objective, we will analyze convertible securities and their financial effects. One way that companies can increase cash proceeds from preferred stock and long-term bonds is to include provisions making the securities more desirable. One such provision is a conversion option that allows the holder of those securities to convert them into common stock at a preset price. While investors own the preferred stock or long-term bonds, they receive dividend or interest payments and will have a senior position to common shareholders in the event the company fails and is liquidated, since the preferred stock and bond investors are paid before the common shareholders. On the other hand, if the company performs well and its prospects are good, the preferred stock or bond investors can exchange their securities for common stock at a pre-agreed exchange ratio. They have the option to become common shareholders. In that case, they can benefit from the company's upside potential, and the value of their common shares will increase as the market value of the company increases. This conversion option is valuable to investors, and they are willing to pay a higher price for convertible preferred stock or convertible bonds when they are issued. For the company, the issue proceeds are higher. Earlier, we described the convertible preferred stock issued by Corning, Inc. Bonds can have a similar conversion option. Until bonds are converted, bondholders enjoy interest, income, and a senior position in liquidation. But if the company performs well, bondholders can convert their bonds into common stock and enjoy all the benefits of a common shareholder. For many years, Tesla has used convertible bonds to finance its growth. As of 2018, Tesla had outstanding convertible bonds amounting to $5.7 billion, over half of its total long-term debt of $11 billion. After December 15, 2021, bondholders can exchange each $1,000 bond for 3.0534 shares of Tesla common stock. Until they convert, the bondholders earn 2.375% interest. Conversion of the bonds is advantageous to the bondholders if Tesla's stock rises above the $327.50 conversion price, computed as $1,000 divided by 3.0534. To see the effects that conversion would have on Tesla's financial statements, assume that on December 31, 2021, bondholders convert $600 million of the total $977.5 million bond issue into 1,832,040 common shares with a par value of 0.001 cent per share. The financial statement effects would be a decrease in liabilities of $600 million and an increase in common stock of $1,832 and additional paid-in capital for the difference of $599,988.17 million. No gain or loss or cash inflow is recognized as the result of the conversion. In this learning objective, we will interpret earnings per share. A common metric reported in the financial press is earnings per share. Earnings per share is the only ratio defined by GAAP, a testimony to this ratio's perceived importance for users. During the earnings season, the time each quarter when public companies increase their quarterly earnings report, EPS disclosures are followed obsessively by Wall Street analysts and investors. Basic earnings per share is computed as net income attributable to common shareholders divided by the weighted average number of common shares outstanding during the year. Diluted earnings per share includes basic earnings per share, but also includes the impact of additional shares that would be issued if all stock options and convertible securities were converted into common shares at the beginning of the year. We must be careful in using EPS when comparing companies' operating results, as the number of shares outstanding is not necessarily proportional to their income level. That is, a company with twice the level of net income does not necessarily have double the number of common shares outstanding. Management controls the number of common shares outstanding, and there is no relation between firm size and number of shares outstanding. This slide shows Johnson & Johnson's basic and diluted earnings per share ratios for 2018. Johnson & Johnson uses the treasury stock method to determine the dilutive effect of stock options. This method assumes that all options are exercised, resulting in an additional 139 million shares being issued, and then the company uses the proceeds to repurchase shares on the open market at the current stock price. An additional 92.5 million shares of treasury stock acquired. The 46.5 million share increase is the net effect of the shares issued to option holders less the new Treasury shares. The combined effect is to increase the number of shares in the denominator from 2,681.5 million for basic earnings per share to 2,728.7 million shares for diluted earnings per share calculations. The increase in the number of shares in the denominator reduced 2018 basic earnings per share of $5.70 to diluted earnings per share of $5.61. And this is the end of Part 2 of the presentation for Module 8 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.